Hey, welcome to this week's video. In this week's video, we're going to talk about the Work Opportunity Tax Credit, or better known as WOTC for short. And in particular, is the WOTC tax credit worth taking or not? And what exactly is it? In this video, I'm going to explain what it is and how it can be a big tax saver for your business. So let's get started. Generally, the Work Opportunity Tax Credit is based on wages paid to a certain targeted group, and it's going to be based on a percentage of those wages up to a certain amount. So in general, it would be 40% of wages up to $6,000, which would be $2,400 credit. And that is going to be different based on the different targeted groups that are allowable under the Work Opportunity Tax Credit, which I'll get into. The tax period is a year from when the eligible employee starts, and there are also special rules for certain other classes of targeted group, and that can be a difference maker in the total credit that you're going to be able to receive, which I'll get into later in this video as well. So to be an eligible employee, you need to certify that employee either before that employee starts or within 28 days after that employee starts. Now you do this by filling out a form. It's called IRS Form 8850, but you don't send it to the IRS. You send it to what's known as the State Workforce Agency, or SWA, and they're the ones that are going to set the targeted groups. So you send that into that agency. They're going to certify or pre-certify that employee, and that way you know that you'll be eligible to take that credit on a later date when you do your income tax returns, which is when you will then file and ask for that credit. So here's a list of the targeted groups, and as you can see, it's kind of a wide range of different people that can qualify for this credit. So for example, on the list are veterans, and it could be veterans that have disabilities or have been unemployed for a certain period of time, or both. It also can include ex-felons. It can also include people that have been on supplemental Social Security, and it also includes youth that are in certain qualified zones. So the list is pretty wide, and I would encourage you to kind of take a look on the website of the SWA that I mentioned earlier, and it'll give you a good list and good understanding and more definitions of who specifically are targeted and what exactly are the eligible requirements. So calculating the credit and determining the amount is going to be different based on the targeted group that you are hiring in your company. So generally, as I mentioned earlier, it's 40% of wages up to $6,000 or $2,400. And also, if the eligible employee works less than 400 hours but greater than 120 hours, you're going to get some of that credit as well. And if you have a certain targeted group, for example, let's say that it was a veteran that has been unemployed for the last 6 months, you may get a higher wage base, which will give you a higher credit. And then also, if you took that same individual and they were also unemployed for the last 6 months, then you get an even higher credit. So as you can see, it really depends on the wages. It depends on the targeted group of how much of that credit you're going to get. So for each one that you hire, it's worth it to go through and get them certified, but also to kind of plan in advance what you should expect from that particular credit so that you can plan accordingly. Okay, so there are some limitations, but having said that, there are not a lot of limitations. If you've gotten through the phase where you have certified that employee as being part of a targeted group, then really the limitations come down to not double dipping on any credits that you may have taken already in your income tax return. So if you take the credit, let's say that you have $100,000 of wages that you paid and you have credits of $30,000. Well, you can only deduct in your tax return $70,000 of wages, not the full $100,000. So you can see it's limited by the amount of credit that you've taken, so you're not double dipping. The same thing goes for other credits that you may have taken, like the employee retention credit that's very popular. So also the other thing to keep in mind is the employee can't be related to the business owner. So some of these things are very easy to follow and are not very limited, but it's something to keep in mind as you go through the tax credit that you want to do up front before you take the time to certify that individual. So, how do you claim the credit? Well, you're going to claim the credit when you file your business income tax return, and you do that on IRS Form 5884. The thing to keep in mind is that even if you are unable to deduct that credit or to claim that credit because you may have a net loss in your business, you can carry it back 1 year, and actually you can carry it forward 20 years. So the chances are you're going to be able to take that credit. So it's definitely worth spending some time and calculating it and getting it right on that IRS form. So in summary, is the WOTC or Work Opportunity Credit worth taking? It definitely is. If you are able to identify an individual that is part of a targeted group, you're not only getting a tax benefit, but you're actually helping somebody out that really needs the help, and it's a good thing to do. Plus you're getting a benefit of helping them as well. So also the credit is in place now through 2025. You can take the credit back and forward just like I mentioned earlier. So it's definitely worth looking out for. I'd be curious to hear down in the comments if you are currently taking the WOTC credit and what are some of your experiences with it. That'd be great if you can leave down in the comments below. And as always, I really appreciate you checking out this video, and if you haven't subscribed, that'd be awesome. And if you get some value out of this video, it'd be awesome if you hit that thumbs up. Okay? Until next time, thank you for watching this video.